Good morning, everyone. Welcome to a special workshop for finance theory class run by Professor Tom Smith. My name is Frank Liu. I'm from University of Western Australia. I'm currently a senior lecturer of finance there. Thank you, Tom, for inviting me to do this talk again. And I've been doing this in the second module for finance theory over the past 8 years. So this is my ninth talk or my eighth talk. I really have lost count. So for this section, we'll talk about state prices, market volatility, skewness, and applications. So basically, we're going to talk about the applications for state preference pricing model that you learned in finance theory, and then talk a little bit about continuous time finance. On the bottom left of your screen, you can see a QR code. So if you scan a QR code with your phone, that will take you to a website, which is also listed here, www.frankliu.info/prezi. That will take you to see the lecture slides. I mean, not lecture slides, but the slides that you see in front of you. And I think a PDF version of this will also be made available in your Dropbox share folder. Normally, this talk will go for about 90 minutes with interaction face to face. But this year is a bit special. It's the first time that we ever do it online as a recording. So I'm not sure how long that would take. Hopefully, it would take a lot less than 90 minutes. No one really wants to hear me for about 90 minutes, right? All right. So the talk today will be composed into three sections. We'll start with volatility, move on to just cover a little bit about partial moment volatility, and then talk about skewness. If you have any questions, you can send an email to me. The email address, well, if you use Google, you can Google me on, you can find my email address on Google on my school website, or it would just be frank.liu@uwa.edu.au. I'm not sure why I didn't have my email address here. Probably because most of the time I will already write my email address on the whiteboard for you guys. All right, without further ado, let's get started. All right, volatility. So why do we care about volatility? Why do we care about risk and time in finance? Well, as noted by Campbell, Low and McKinney in their 1997 book, what distinguishes financial economics is the central role that uncertainty plays in both finance theory and its empirical implementation. So you can say that the starting point for every financial model will be the uncertainty facing investors. So which means that without uncertainty, the problems of what we do can be reduced down to an exercise in basic microeconomics. So that tells you that you may learn from your introductory to finance unit that volatility is very important when you want to measure the systematic risk, right? So we care about volatility, and so that then that takes us to the next question, which is we care about volatility, so that means we want to forecast that. For whatever reason you want to do it, because you want to forecast the future trajectory. I want to know, have a little bit of confidence about how likely my NPV will be positive and all that. So people like doing volatility forecasting. It's being discussed in following context. And if you actually doing these topics in your PhD, I highly recommend it for you to read these two survey papers by Poon and Grander and Anderson et al. So it can be broadly discussed in three contexts. The first one is historical volatility, which is basically saying, I want to use the past month's historical volatility, realized volatility, as a proxy for next month, or I can use last year. It's quick and easy. Everyone would have covered how to calculate standard deviation, right? Using that to calculate as the proxy for future volatility. It's quick and easy. But the problem here is that how far back should one refer to? Would you have to go back for 1 month, 2 months, 6 months, 1 year? Maybe that maybe the longer you go back, the more irrelevant that it becomes. And the second category is using arch and gauge volatility. Basically, you can think about the time varying function or current variables. For example, if you take gauge, is a weighted function of a long-term average, the past variance that you just observed, and a component that is not explained by the current model, and that will be your future volatility. But what we want to focus today here is the implied volatility, right? Implied volatility, again, I believe this is all covered in your undergraduate study, right? Implied volatility is implied from the option prices. It's basically invert the analytical pricing formula for some option pricing models if it exists, if you can write in certain format, or you can follow some model-free approaches to figure out when people putting the prices into these options, what is the volatility they have, embedded in their prices. So here we're gonna start with looking at VIX, a volatility index, and then we're gonna introduce our state price volatility index. And the reason why I want to go through the VIX first is because, well, partly because VIX is very important. It's important both, in a practical sense that people view that as a fear barometer, and also it's important for finance researchers that because it's a good proxy. It's a good proxy for many empirical models for the market fear, right? So it's quite powerful in your regression. So a brief history of VIX. I think some of this coming from Carr and Wu 2006 paper. So VIX was originally introduced by Whaley in his 1993 paper. The original VIX is based on OEX options, which are American style, based on the S&P 100 options. And you can think of the original VIX is an average of the Black-Scholes implied volatilities on 8 near-the-money options at the 2 nearest maturities. Because now we have the new VIX, so the old VIX is called VXO. I guess O stands for either original or the OEX options. One of the criticism that the original VIX received was the artificially induced upward bias from their trading day conversion, which is listed over here. You don't have to worry about it because we no longer need to know that, because now back in 2003 they have revised their methodology, and now the new VIX is based on the S&P 500 options. They're a lot easier to be priced theoretically. They're European style, and it's based on a model-free approach. I would say, I will give a quotation mark around a model-free, which is what we'll talk about in 10 minutes. Is a model-free approach by Murphy, Derman, Kalman, and Zhou, 1999 paper. Is an internal research note in Goldman Sachs. It corrects the artificial upward bias from the previous trading day conversion, but it has done a lot more than that. All right, so and as I was preparing for this, doing my revising my workshop slide, I was just saying, how about just looking at what's happening in the market? I mean, with COVID-19 that taking over the stage, everyone talked about COVID-19, economic downturn, and all that, right? And then, but let's just say, what kind of news can we actually get on CPOE VIX if you just go onto Google? You can see that as of on 2nd of May 2020, there were there were people talking about VIX suggesting a bottom is in, or is it more downside in store? And but you can see that VIX still grab a lot of attention. And if you're looking at its past trajectory, so this is the movement since, I think that is from 2003 to 2020. I think over here, if you look at the green trajectory, on the very right hand side, you will see that's the recent movement in 2020. I think due to the sampling issues over here, in 2020, we have actually seen the highest point of VIX, but I think this Google Finance map, when they're trying to do this plot, I think they was doing the weekly figure over here. So you can see that this is probably well discussed in many contexts. Whenever you read the financial news, people saying VIX goes up, people are fear about what's happening in the future, because when everyone panic, everything goes down, but the only thing goes up is VIX, right? So over the past 10 years, really from the end of 2012, we haven't seen huge movement in VIX, right? You can see, those spikes here and there around 30-ish, around 2016 and around 2018, but the real movement really kicks in since March of since February and March in VIX. All right, so this is quite well behaved in the sense that it kind of matches about people's expectations. When the market goes down, VIX goes up, right? And lately the movement in VIX has been quite dramatic. right? You see that as of May 1st, the movement overnight was 8.9%. That's definitely not small. So why do we care about VIX? Well, VIX is known, as I said before, is known as the fear index, and CBOE has actually extended their methodology into covering different markets. You see a VIX for S&P 500, VIX-N for Nasdaq 100, and in Europe, this is probably the second most popular VIX index for people to follow is the VIX stocks, right? So there will be a fee index created for most major markets. You also have a VIX derivative for interest rate, for ETFs, and even on single stocks. But you haven't really seen much success in single stocks. That's probably why they're only producing VIX for these 5 single stocks. Partly because there's not many products traded on that, not much liquidity. So why do we care about VIX? I mean, apart from they rolling out their methodology to extend to cover every market, well, that's mainly because there's a demand for it, right? People trade volatility using VIX derivatives and ETPs, exchange traded products. So we can see that VIX futures was made available in May 2004, so it almost marks 16 years anniversary. The average trading volume grows from about 1,000 to about 150,000 contract per day. And then especially the increase, the surge in VIX futures and options trading after the GFC. So when the GFC happened and people see the market meltdown and people panic and people think about, okay, if I want to protect my long position portfolio, what's the best way to do that? Then I'll be betting on volatility, because if everything goes down, volatility goes up. I want to buy something that related to volatility. But of course, you can't trade a VIX index itself, just like you can't trade the S&P 500 index itself. So then I probably can write a futures contract on that. I can write options on that. So that means that buying a long futures position or long VIX options is kind of like buying an insurance. It's kind of like saying, okay, if everything goes down in the equity market, the one thing that goes up is VIX. So that means that I get a little bit of cover. So people view that as an insurance. And then, of course, there's a huge demand for that back in, after the GFC, in the post-GFC era, there's a huge demand for it. That's probably why people care about VIX in that sense. And in fact, I think from 2016 onwards, a VIX-related product has exceeded 50% of its total revenue that earned by Chicago Board Option Exchange, right? Has become one of the most popular products suite. And there are many exchange-traded products linked to VIX since 2009, and a few of them went bursted, which we'll talk about in a second. So VIX popularity, and this is an old figure, but you can see that over the time it has gained its popularity, and I won't be surprised in 2020 you will be way above there as well, right? Okay, nothing to worry about here, and nothing to worry about here as well. That we just talk about VIX index being well behaved in the sense that when we see the trajectory, and when we compare that to the market equity movement, we understand that everything is kind of explainable. When market goes down, VIX goes up, right? When market panics, and the fear index goes up. So this is where what I want to talk about the exchange traded product related to VIX. And so back in 2018, about 2 years ago, people filed a lawsuit after losing their entirety in XIV product. So if you haven't really followed VIX volatility index in general, you probably don't know what XIV is. But have a wild guess about what XIV is. Well, XIV is just another way of writing, from right to left, VIX. So you can think of it as an inverse VIX, which means that it was a exchange traded note that designed to track -100% movement of VIX. So on a day-to-day basis, if VIX goes up by 3%, XIV should go down by 3%, and if VIX goes down by 3%, XIV goes up by 3%. So in fact, up until 2018, XIV was probably one of the more profitable or more popular exchange traded notes for investors, because it's probably the only one that it really held its value, that haven't really if you're a long position on that, right? Because since from between 2011 and 2018, really, VIX has been staying at a relatively low position. So I mean, so which means that so for people who betting on VIX going up, they probably have lost a lot of money. But for people who betting on the opposite, they probably have done pretty well. I mean, I'm not sure the actual alpha for that, but they have done pretty well up until 2018, where there was an overnight movement almost 100%. So if you read this paragraph down in the bottom, then on February the 5th, the VIX jumped 100%. So by design, if something jumped 100%, and if you're tracking the inverse of that, so that means that you were supposed to go down by 100%. In finance, when you go down by 100%, what does that mean? That means is you're losing entirely, right? And that's why the investors are not sure about it. Say, how can that happen? Of course, that could happen, and it's actually an exchange traded note, right? So all that just tells you to sort of like gives you an idea about how popular VIX is, and then to show you about the state preference pricing volatility index that we're going to talk about in this workshop. We're going to go through VIX methodology first, just to show you how they couldn't be more different from each other, but then yet they arrive at rather similar figures. So you can take this as a VIX 101. We're going to spend about 20 minutes talking about how you actually derive VIX, because when we talk about VIX and we see people doing empirically about how to calculate VIX, it probably worthwhile to think about how you actually calculate VIX. So unlike the normal equity index, S&P 500 is just evaluated company returns. Over here is slightly different. So what we have on this slide is the VIX formula. So to calculate VIX, people start from variance first. So here you have sigma squared, sigma j squared. J here stands for either the first series or second series, near term and next term, because which we'll cover in a second. So equals to 2 over Tj times summation of delta Ki over Ki squared times ERT QKI minus blah blah blah. Let's just talk about what each symbol stands for. Tj here is the time to maturity measured in a fraction of a year. Delta Ki here is a strike price interval. Ki squared here, K is strike price. So you can see is some sort of like an interval, strike price interval weighted by strike square times and time value of money times the option price. Q here is the option price. It can be either call option or put option, depends on whether it is out of money put or out of money call. So F here is the forward price based on the current level, and K0 is the first strike price available below the forward price. So you can roughly think about that the VIX or the VIX squared, the variance here, is a summation of a whole bunch of option prices, each weighted by a strike price squared. And then once you calculate sigma squared, and because you have two series, Y2 series, because VIX is supposed to tell you, not supposed to, it's designed to tell you what the future volatility is going to be like over the next 30 days. And when you're trying to when you're trying to get information out of the option series, you know that options, the expiration date changes. So which means in order to get the exactly 30 days, you're probably more likely to be interpolate between two different expiration series. That's why you calculate this for two different sets of options. One usually expires within the next 8 to 23 days. The other one will be the next monthly series. And then once you calculate that you get a sigma square, and you then apply this interpolation technique in the second formula over here to get a VIX. So okay, but that is just the VIX formula. They revised that in 2003, but they haven't done much changes apart from using different series of options to calculate that. And for the next 10 minutes, we're just going to go through how you can actually derive it. Partly it's because it's fun. I think it's important to know it. The other part is to show you that it's actually not exactly model free. So it was so derivation of that is presented in DDKZ 999, and And the idea here is that the realized volatility can be captured by the dynamic hedging of a lock contract. You probably don't know what lock contract is. If you do know in some of your asset pricing unit, that'd be great. But if you're not sure, we're gonna keep going. We'll talk about that in a second. So you can think about a theoretical definition of realized variance for a given price history is the first formula over here, V, realized variance equals to 1 over T, integrate from 0 to T with sigma square here to be a function of T and many other things. So here we're just saying, okay, it's a function of minimum T, and it could be anything, it could be every other things, and dt. So you can think about that if you're assuming a constant variance, which means the variance is not a function of anything, at least not a function of time, then that integration formula can be summarized, can be simplified into sigma squared times t, right? And then that just means that v equals to sigma squared. So then we arrive back to our original assumption that variance is a constant value. But over here, of course, in order to write it in a general formula, we're saying the realized variance here, can be equal to this sigma function that is a minimally determined by t. And you can think about pricing a variance swap. So here, the value of the variance swap f equals to expected value of present value of v minus k. So here you think about a long position. Minus k is what you're gonna pay. V is what you're gonna receive. You're gonna receive the asset. You're gonna receive the realized variance. You're gonna pay a k fixed amount. That's not something new that you should learn in your undergraduate unit. In order to make it fair for any position, then for a zero initial value, the k variance that you agree to pay should be the same as expected variance, because if you fix f to be 0, you arrive at k var equals to ev, which you can then write into, bring your first formula down, 1 over t times expected value of this integration 0t sigma squared t dt. All right. If you have a piece of paper, I actually encourage to copy these formulas down because it's actually quite fun to derive VIX together. It looks intimidating, but it's actually very straightforward. I would say this is, you don't need anything more than high school math. All right. So DDKZ backing, so they only assumes that future underlying evolution is diffusive. So over here, no jumps allowed. And I remember that maybe in the original paper they did have an extension for allowing for jumps. But anyway, so over here they say, okay, the future underlying evolution is diffusive. So that means the dst over st here can be written as a mu t times dt, the drift component, plus the diffusive component over here. Zt here obviously is the Brownian motion. If you apply for the Ito's lemma, right, so the d log st over here will be equals to, this is what you learned in your finance theory, can be written as mu minus half sigma square times dt plus zt. And if you're staring at them for long enough, you will say, here, hang on a second. I've got dzt on the top and I got dzt on the bottom. What if I just subtract one from another? So what if you have dst over st minus d log st? That would just left with half sigma squared dt. So, and then rearrange that, you can write sigma squared dt equals to 2 times dst over st minus d log st, right? And then substitute that one back to what we know for the k var. So k var here equals to 1 over t times expected value of this variance function integrating from 0 to t. And we just, after assuming for the diffusive component for the underlying dynamics, sigma squared dt equals to 2 times the bracket dst over st minus d log st. If you substitute that one in, what you have here is 2 over t times expected value of two integrations from 0 to t, dst over st and d log st. So to make things slightly clearer, I was just gonna put the first one into a, the first integration into a, and the second one I denoted as b, and then we're gonna derive them individually and then combine them to show you what expected value of variance, or the k var here is for the variance swap. A here, remember A here is dst over st. So they assume that we are in a risk neutral framework. So that means in this case, no longer you have mu here for the drift component. You replace with R. So the expected value, which really should be EQ here. The EQ here of integration between 0 to t r dt times plus sigma dzt. And you know that the Brownian motion here, the expected value of that is just 0. So that means part A here is simplified down to just RT in the risk neutral framework. For B here, and B equals to E log ST over S0, and you can introduce an arbitrary number such that S star, such that here they become E times log ST over S star plus log S star over S0. And the reason why you can move the S star over S0 out of the bracket of the expected value because S star here is some arbitrary number that you know, and S0 is current values, current spot price, that's also known. So the expected value just themselves. And the expected value of log ST over S star here, and this is known as the log contract, right? And the reason why, empirically people choose S star here is just to define a boundary for out money calls and put. So if you're not doing your research in options, then you probably don't know why people care so much about the out money calls and put. And in fact, you don't have to, because I think there's a management science paper in 2019 that talk about why you should also include in the money calls and put. There's a lot of information embedded in the money options as well. But I think empirically, people have really just focused on out money calls and put, mainly because it's liquidity, right? You get a lot more people trading out money options for index. All right, so, and then, you can see that A simplified down to RT, B simplified down to a log contract plus log S star over S0 at known value, and the rest is just to work out what that log contract here is. To do that, we're actually doing backward. So let's just say, how do you value that? Let's suppose we buy a portfolio of options, fine, spanning all strikes. The strike price go from 0 to infinity with its expiration t and weighted inversely proportional to k squared. And you would say, well, why does it have to be so specific? Remember, we're doing this kind of reverse engineering. So what we have here is that, well, it took me a while to figure it out when I was first learning how to derive VIX. I don't think it's written anywhere for you to show you how that's derived. So, but let's just say if you're looking, from a reverse engineering point of view, the value of this portfolio, the portfolio of options, equals to here all the out money puts. So here you can see the integration from 0 to S star. That's because you're buying every single out money put option available. That's with strike price going from 0 to an arbitrary S star, which is if it's below S star, that is out money put. If it's above S star, that will be out money calls. Then move on to the second component of the first equation. So here is integration from S star to infinity, where because remember you're buying a portfolio of options, option price, and each weighted by a strike square, right? K squared. And if you trust the math, and that can be written as the either it can be written as that. So if ST is less than S star, so when you actually come to the expiration day, you can see that if ST is less than S star, then one of them is going to be expire worthless. In this case, you should know which one that is, right? So one of them expire worthless, the out of money call options expires worthless. So then all you have here is the first component of the put option. And then here you can replace the 0, because if it's below ST, because if your strike price is lower than the ST, would you exercise that? You wouldn't. So which means you would only exercise the group of options, out of money put option that had a strike price between ST and the S star. And vice versa, for ST greater than S star, you would only exercise a certain proportion of out money calls, which is why you can replace the 0 and infinity in the first line of equation replaced by S star over here. And then if you know about integration from if you recall your integration techniques from your high school, then you know that they both can be written in this third equation, in the third line. They can both be simplified down to here minus 1 minus log st plus st over s star plus log s star. And that can be rewritten as st minus s star over s star minus log st over s star. And that rearrangement is necessary. But that shows you, because remember we want to value e log st over s star, which is the second component of the line 4, then that means we know that that can be rewritten as expected value of this st minus s star over s star minus this portfolio, right? Minus this portfolio, if we know what that portfolio is. All right, that's important. We so far we just assume that we know what that portfolio is. So now if you bring part A and B together, the k var here is written as 2 over t times rt. Rt is A, and minus 2 over t times that bracket here is part B. And do a little bit of rearrangement. So because now you're watching video. I hope you're still watching video. We are about 30 minutes down into the workshop. Hopefully you're still here. If you are here, give you a thumb up. Just you write it down, and it's just a quick exercise for you to think about how to derive VIX. So over here, you can see that st minus s star over s star, that can be simplified down to just expected value of st here, right? And the expected value of the phi of the whole portfolio is just a sum of two integrations, right? Everything else is known. You can move the non-value out. The only thing I want to point out here is that the expected value of st is just S0 ERT in this risk neutral framework. Everything grows up as the risk-free interest rate. And the reason why I keep saying that is because, remember, they're saying assuming a model-free approach, but in fact, it's actually not going to be a model-free approach as we show you. And then to show you how that going to be simplified down to the VIX formula, I'm just going to decompose them into two components again, a small a and a small b. So you can think about the small b here is just expected value of the phi there, right? So here I replace that maximum of that by the put option price and call option price respectively, and now I just think about how we can simplify each component, right? All right. So for A here, how do we actually get from A to the component in VIX formula? So you can think about this: 2 over t times the long fraction, the long equation over here, and you can bring the s star from the log into the ERT there. So what we have done over here is that we have moved s star and log s0 together with ERT. And when you have log S0 ERT, you know that that's just f, right? That's just the forward value. And then that can be written as, if you replace f equals to S0 ERT, that just becomes that. And in fact, that value can be calculated exactly. The reason why the point that I'm not sure about why CBOE does that to write a log function into a Taylor expansion is actually really beyond me. I'm not sure why they are doing that, right? Because that number is known, you can just calculate it, right? But if they choose to write that in Taylor expansion such that just becomes log f, and f over s star can be written as f over s star minus 1 minus a half f over s star minus 1 square, and that just becomes approximately minus 1 over t times f over s star minus 1 square. And you can see this is if you then compare with the VIX formula, let's see where I have it, VIX formula, you can see that this is just the second component over here. All right, and then we just need to think about how we can derive the first component of the VIX formula there, right? So that's what a part A, excuse me, that's what a part A simplified to. Let's look at the small part B. For part B over here, and which equals 2 ERT over T times 2 integrations. And so they have done two approximations over here. The first approximation is that in real life, of course, we don't see options quoting from 0 to infinity. Even for one of the most liquid options out there, S&P 500, you would have two boundaries, which is the minimum, the lowest amount of strike price that you observe today. What's the lowest value today, and what is the highest value? So the 0 and infinity is replaced by KL and KH. KL here is the lowest out of money put options strike price, and KH is the highest out of money call option strike price. And then the second type of approximation is the discretization. So over here, of course, the strike price doesn't quote in a continuous sense, right? And which means usually you will see that for an index options, when it's far out of money, each strike price interval is roughly 25 points. When it's close to near the money, this interval strike price interval is roughly 5 points. But the point here is that it's never an infinitesimally small value. So which means that you can't actually calculate the integration. So that integration can only be approximated by a summation. So that becomes the delta Ki, which is dk over Ki squared times ERT times the option price over here. And that you can see that now we got VIX formula, which is based on a variance pricing and variance swap, and that can be approximated by the right hand side, which is the right hand side is a sigma square VIX, right? And if you're not sure, and if you say, oh geez, that's fascinating, but I want to watch that again, feel free to do that because this is a recording. Unlike for the past 8 years, it's always a live workshop. This is actually a recording, so you can go back and just think about how you can arrive at a sigma square VIX formula over here. So why do they do the switch? Why did they do the switching back in 2003? I mean, first of all, the S&P 500 options are more popular, a lot more popular. The popularity and liquidity surpassed S&P 100 options back then, even today. And the methodology is now claimed to be a model-free approach. And that's very important because that means theoretically one can replicate a pair of VIX futures and options. So once you can replicate something, from the financial risk management point of view, if you can replicate something, that means you can actually come up with a contract and that becomes tradable. So which means now we see that a surging popularity of VIX futures and options to be traded for volatility hedging purposes. Any drawbacks? Well, if you watch the derivation closely, you know that there were truncation errors and there were discretization errors. So here, that was originally discussed in Zhang and Tan 2007 paper. So here let's look at a summary statistics of average numbers of out-of-money options. So this statistics based on an older data set between 1996 and 2013. So what we have here is that there are many columns, but all you need to just focus on is the sort of like the near-term panel. So let's just say take a number. Let's just say take 2002 call average mean 15.4. What does that mean? That means in 2002, on average, on a daily basis, on average, there are about 15 options going to call option. There are about 18.5 options going to put option on average, right? But what really worries you is the minimum. So the minimum over here in 2002 is 5 for call and 8 for put. But what does that mean? That means that there was one day that there was only 5 strike prices available in the out money call range to be used to calculate the VIX. Where in the put side, on the out money put side, there's one day that had minimum of 8. So if you want to think about, in the model derivation, we're seeing that you assume there's an infinite amount of option strikes available there, right? So you can think about how confident would you be to actually approximate and that the whole infinity thing with just either 5 or 8 options. For this second table over here, we're looking at summary statistics for strike price ranges, excuse me, of out-of-money put options when you think about ranges in terms of over the at-money level. So again, let's just take in 2002 number as a figure, as an example. So near-term bottom 2002 0.73. That just means on average the in 2002 on average the out money put strike price is 73% of the at money level. Again, that's on average. But what worries you is the maximum over here. So 0.89 is the maximum for bottom in 2002. That just means that the lowest out money put option only went down to 89% of the current at money level. Which means if you think about current index is 1,000, 0.89 here means that it only go down to the lowest out money put strike price is 890, which means anything beyond 890, 880, 870 was just not quoted, not traded. Likewise for top, in 2002, the top here is 1.14 as an average, but what worries you is the minimum 1.04. So if you think about the index, the at money index is 1,000. 1.04 means that there's one day that the highest out money call option has a strike price is only 1040, and anything beyond that is just not quoted, not traded. So that tells you the big truncation done because of what we observe empirically, right? I mean, you can't really complain about the model because model of course model wants more data, but here the bottleneck is the market data, right? That's true even for one of the most liquid options, the S&P 500 options. You can think about what would be the case for the individual stock options. All right, these two tables should show you that empirically we're suffering from the limited availability of data. So is there any other drawbacks? Well, linear interpolation of two time series, two series of different expiration date may induce an error. If model free implied variance does not follow a linear function of maturity, and mechanically high weights are allocated to out money options, out money puts. So VIX may be manipulable by trading relatively cheaper deep out money put options, because think about each option is weighted by strike price square, such that in this case the lower the strike price for out money put options, the higher weight that it receives. And then why not consider trade volume? So if you think about as a weighted average of the opinions from the market, then if you have a lot more people trading a certain range of the out money options, why wouldn't they receive a lot higher weight in terms of if you just only have one single person putting a single quote for a certain strike price? Why not consider trade volume? And all that just shows you that there's a hint that VIX is actually manipulable. So here is a screenshot of a letter back in February the 12th, 2018. What you want to see, the highlight here is that we urge the SEC and CFTC to promptly investigate the matter before investors suffer additional losses due to the fraud. So there was a whistleblower that the VIX is actually manipulable and was manipulated. You can Google it to see the whole case. And in fact, there was a RVS paper actually talking about this manipulation in the VIX. Is actually VIX manipulable? And they're showing that, well, empirically, there's a strong evidence that it was manipulated, especially before just before the settlement. So what I want to talk about here is that, again, I found that it's really interesting. So so just want to spend about 2 minutes talking about that paper. So put options, VIX sensitivity. And so if you have seen the VIX formula derivation, then you will know that mechanically, because each option is weighted by strike price square. So on the top panel, if you think about put options, VIX sensitivity, the far out of money options, the one that would have really small strike price, the weight actually is a lot higher. And if you compare to trading volume, so the settlement trading volume over here for far out of money options, they're a lot more heavily traded comparing to the at money options. So that gives you a hint of something, of that maybe just for the settlement, people were trying to move the VIX value by trading the far out of money options. and I found that figure, in particular figure B, panel B from the previous figure was really intriguing. I was like, all right, see what I can actually replicate it. So I spent some time on it. I said, I've got the data. Let's just see whether I can replicate it. So when you replicate it, if you compare the previous figure over here, see that the blue line over here, settlement volume on average, that was about roughly about 5,200 over there. So I say, what if you actually decompose that into by years, right? So if you decompose that to by years, you can see that the majority of that coming from 2008, coming from a period where people actually fear about the downside. So which is not a big surprise for people to bet a lot on the extremely downside, right? And if you're looking at every other years, so over here it is the color of the lines represent different years. You can see that that's majorly put up because of 2007, 2008, and 2011, which there was a lot, the market, there was a lot of market turmoil back in 2011 as well. So it's not a huge surprise when you decompose that into this. So you would say, when you first looking at that figure, part B, you would say, well, geez, that is like a miracle that is almost mirrors 100% of what a theoretical VIX sensitivity is to the 5 out of money options. So it looks like there is a manipulation out there, but if you decompose them to by years, you would say a lot of that is actually quite normal in terms of for all the other years where there isn't really a big panic in the market, people actually didn't trade as many prior to the settlement in the deep out of money options, right? And if you're looking at that, so I think that one just looking at 2008 in particular. So if you're looking at that, the majority of the weight is put up by 11 November and October, and then somehow January as well. So you can see that, majority of the weight put up that the spike in the deep out of money options is actually put up because of October and November, and we all know what happened back in 2008 around October and November. That is the time people actually want protection, insurance. People fear, they went up to the deep out of money put options to buy them, right? So I guess the takeaway message to compare that figure to the RFS paper is just to get you to think. As a PhD student, as a researcher, when you see the graph in a paper, you say, "Oh, that looks so interesting. Is that a coincidence that they just matches what the theoretical prediction is?" Because there's so many ways for you to choose how to make a plot. You can take the average, you can decompose the average into by years. So I guess, as a researcher, you should always be encouraged to think deeper, right? Don't take everything as granted, and to think about what actually really drives that spike. So if you allow me to just to go back that again, if you think about what actually happens in that over here in the blue dot over there to put up the average, now you can after decomposing it, you can think about that's mainly put up because of actually what happened back in 2008. Well, the authors would never tell you that, but I think it's important for you to know that yourself, given you have all these techniques. So now let's talk about the state price volatility index. So what a state price volatility index here is a forward-looking volatility index as a proxy for market realized volatility over the next 30 days. It's based on a state preference pricing approach. You learned it in the module 1 in finance theory. So it's based on the what Arrow de Breu framework, state prices. So over here you can think about the fundamental value of any asset prices can be written as a function, as some summation of the future payoff multiplied by the future state price. So if you want to think about you can view the SVX here, state price volatility index square, again like variance, is a financial asset that pays you this dollar amount, log ST over S0 square. So we have plus 0.05 here. We're going to explain that in a second. So here you can think that is a financial asset that pays you this dollar amount, right? Kind of like a log asset square. And then the rest is for us to figure out, okay, what is the state prices? What is the probability here? So you can, because the reason why we have 0.05 there is because state actually ranges from a lowest point to the highest point. And what we done over here is that because we're looking at an interval, right? And so in order to get into the middle of the 10 cents increment, 0.1 increment, then we actually add 0.05 to get to the center of that interval for us to come up with the probability of hitting into a particular interval, right? That's what that 0.05 here stands for. And then how do we get state prices? So the Britton and Lindbergh 1978 paper tells you that a state price is a function can be written as a second derivative of the call option price or put option price with respect to the strike price, second derivative of that. So to see this, you can think about construct a butterfly spread to long one call and at a strike M minus delta M, long one call with a strike M plus delta M, and short two calls right in the middle. So if you write that out in a final payoff function, then you know that when ST is the spot price at maturity less than M minus delta M, none of this is gonna be exercised. And if ST is falling between M minus delta M and M, or between M and M plus delta M, or gonna be above M plus delta M, you can see there's a different payoff function over here. But then you can think about the total value of your portfolio would be delta M plus or minus ST minus M. So which means the payoff is delta M dollars exactly if the future spot price is going to be M maturity, right? So how's that important? Well, because that means that the cost of this butterfly spread that can produce a payment of $1 if the future state is ST equals to M, a particular state, is going to be the long call plus the long call of M minus delta M plus the long call M plus delta M minus two short calls over here divided by delta M. Because if you divide it by delta M, that gives you $1. And if you then divide the above, divide this whole equation over here by delta M again, and then set the limit as delta M approaching 0, what you get here, it becomes a second derivative of call option price with respect to strike price. And how's that important? Well, that shows you that there is an empirical way for you to approximate the second derivative. It's by constructing this butterfly spread with either call option or put option. The formula for put option will be very similar. So that means the price of a security F with payoff DMF as some future state M can be written as the integration of M, all the different states, with the payoff function times the state price. So DMF over here is just the payoff, and times the state price here is the state price that we just talked about before, the second derivative call option with respect to strike price times DM, right? For every single M. So as an example, we can think about pricing a European put option. We know that the price of the put option can be found as the price equals to expected value of discounted K minus ST plus here means maximum of K minus ST or 0. So you can written that into a payoff function, payoff and state price. If you can write write the density function into F, right? So that becomes K minus ST, and you replace the infinity with K because anything above K would not be exercised. So that integration of 0 to infinity becomes 0 to K of payoff times state price. And then we can just think about how we can use the second derivative to come to the same formula over here. So take the partial derivative with respect to K, dp dk becomes delta of the whole integration, delta K, that becomes blah blah blah, that becomes E minus RT Fk, where the F here is a risk neutral distribution function. If you then take the partial derivative with respect to K again, and that becomes E minus RT Fk, which is you can write the P put option price equals to K minus ST, E minus RT FST DST to be the second derivative over here, because E minus RT Fk is the same as the second derivative, right? That shows you here equals to the payoff function times the density times the state prices. I don't think that's an example for your finance theory, but it's just fun for you to know. So how do you approximate a second derivative? So for the model free approach, that can be written either as a bunch of co-option price together, like constructing a butterfly spread divided by the strike price interval square. Or if you have a lot more data, and you can use a slightly more refined approximation as introducing Aberle 2008 paper over here, can be written as second equation. But but unfortunately, it fails to deal with the real world data because you could observe empirically, you could observe equal option prices for deep out money options, which leads to zero stay price. You can also observe irrational bids in deep out money options because the call could be stale, that it will lead to negative stay price. And even when prices of out money options are rational, everything follows, but it can still possible to see P minus 2pi plus pi plus 1, that could still be negative. But of course, we can't have a negative stay prices. So what we have done over here as an empirical choice here is that we use Black-Scholes stay prices that was discussed in Burton and Lindsberg 1978. So here the stay prices, it can be written as E minus RT times 2n function, nd2ki minus nd2ki minus plus 1, and d2 function is well defined in the Black-Scholes framework. But a key input here in nd2 is the sigma, where the sigma is estimated as the average of the implied voltage from two money calls and put from two maturities that are closer to 30 days, which in the past literature people have talked about how that is very much linked to the future volatility. So that becomes the input for the state prices. So just to show you how we construct, empirically how we construct SVX, we used the empirical data from 1996 to 2013, and we get our SPX options from option matrix. We use the standard way to calculate for the interest rate, adjusting for dividends, and so on and so on. And then we use normal filters to filter out the S&P 500 options. And what we have here is the past trajectory. So over here on this figure, the S&P 500 is this purple line, which is the one that goes up and down between 1996 to 2013 in this case. VIX is denoted in the red color. The old VIX is the blue color, and the green color is the state price volatility index that we just constructed together, right? You can see that they almost 100% mimicking each other. Goes up and down together, right? We already talked about how volatility index is well behaved in terms of that it's sort of like it falls into the anticipation of what people believe a fear index should be like. When everything goes down, the VIX goes up. You can see that it's just that's why we want to talk about a derivation of VIX and then the state price volatility index. It really just shows you that even though they are coming from two different methodologies, but they just heavily track each other with a level correlation about 99% and the change correlation about 93%. All right, so what I've done over here is just to show you that so first of all, we're using a simulation to show you that in a different in a different framework where you have different outcome for volatility, when you're trying to use the CBOE methodology to calculate VIX, whether you actually how close would I be able to recover the true volatility, and then comparing to how the state price what the state price volatility index is. So over here I have about so looking at the truncation. So the truncation here is that, remember how empirically we don't have a lot of data, we only have certain range of data. So over here I'm going let's take one of the model, Black-Scholes Merton model, or let's say take a Merton model over here, and we're going from left hand side, which is we have a lot of data, to the right hand side, where over here we have is truncated into close to reality, that we only have about 90% of the ranges over there. So if you think about that under different model assumptions, you can think about what a CBOE does is that you will underestimate the true volatility. As you can see, the line just goes down. The arrow becomes more negative because you're underestimating it, because you have less amount of data. You think about the summation. If you have less amount of component going to the summation, and each one being positive, that just means you will underestimate it, right? And the red line here is the state price volatility index, which doesn't suffer from this type of errors. And very similarly for discretization means that we're going from integration to a summation, where under different model assumptions over here, you can see that you're actually overestimating the true volatility, but where the SVX doesn't really follow the same pattern. So it's, the error range roughly flat right in the middle. That just shows you it doesn't really suffer from either the truncation or the discretization. Asymmetry. So asymmetry here, asymmetry errors just means that because we truncate out money calls and out money puts at the same time, but what if you have a lot more out money puts? Because this is what we have in reality. A lot more people buy index options for insurance. So if you have a lot more people trading out money put option and the range for out money call doesn't go that far, what happens? What happens then? So in this case, in the volatility case, where you're going from you having a very symmetric, truncation, which is right in the middle, 0.00, very symmetric truncation, going from that to either side, which means you have more left hand side, you have more out money put, or to the right hand side, you have more out money calls. You can see that the CBO is suffering from underestimating the true volatility from left hand side to close to getting to the true volatility, and then to underestimating again if you have more of the one side. But where the state price volatility index is roughly have a lot lower error range compared to the others. All right, so as an empirical exercise, let's just see how closely would I be able to forecast the realized volatility. So here we have 5 different ways to measuring realized volatility. We have the close level, we have RVOP, RVOGK, RVORS, and RVOY and Z. That's just different ways of incorporating the high and low information and or high and low and close and open prices. That's just different way to calculate realized volatility. Typically, people using the first one, just using close to close, but you can go a bit more fancy using the others, right? So what we have over here is that, that's not important. What we have over here is that you can think about, Whaley documents that changing VIX rises at a high absolute rate of change when there's a market fall and an upswing. How about state price volatility index? We show you that for the state price volatility index, it behaves rather similar to VIX. We already see that how the actual trajectory looks like, but in terms of regression, it shows you that when market goes down, VIX goes up and SPX goes up, and when market goes down compared to goes up, the VIX actually goes up a lot more. So that's what you mean by asymmetric. We can see that the SPX also present the same pattern. And in terms of predictability, in terms of predicting the future realized volatility, we have a few ways of doing that. We can have in sample, full sample overlapping. You can see that, for example, for the SVX, the coefficient is almost 1. That means it's almost predicting the future realized volatility 100% at the coefficient of being 1, and with a higher R square than the VIX over here. And you can see that that's the case to be in every single case. You have a high R square, and you have a coefficient a lot closer to 1 than VIX. And when you go into monthly sample, non-overlapping third Wednesday, why third Wednesday? Because third Wednesday, going from third Wednesday to the next third Friday of the month, that gives you exactly 30 days. So which means on those days, VIX doesn't really have to be interpolated over 2 different expiration series. So which means normally on the third Wednesday of the month, you would have a higher predictive power because you doesn't suffer from linear interpolation. So in this case, we can still see that, well, the SVX still has a higher prediction power than the VIX. And I have R squared and the coefficient a lot closer to 1. If you move on to out of sample, so out of sample here you have two ways. You can either have a fixed proportion or you can have a moving proportion. You can see that on SVX on average has a lower errors in terms of predicting the future volatility as when you have different ranges. So I think the one bolded over here means it has the lowest errors and the highest R squared. Over here you can see that SVX topped the chart in about 4 out of the 6 different ways. And when you have a rolling window, a fixed rolling window, which means we have 2 years to train my model, or 3 years to train my model, 4 years to train my model, and I'm predicting the next day. So if you're doing that, you can see that SVX pretty much surpassed VIX in terms of the prediction in every single category. That shows you that although they're using different methodology, SVX tracks VIX pretty well and is a better predictor for future realized volatility. All right. So that concludes our first component about the volatility over here. There are other applications over there. You can read that in your own time. But let's move on to something else, to partial moment volatility and then to the skewness. So here, what is missing in VIX, or what's missing in volatility in general? Well, let's have a look at this example. So here we have asset A and asset B. So asset A gives you a payoff, according to this function. 90% give you a payoff 0, or 10% chance give you a payoff 100. But I'm writing in that format such that you can compare A and B directly. So for B, 90% chance you get paid $0, 5% chance you get paid 100, and 5% chance you get paid 105. So here you can pause for a second and think about which one would you invest. Well, if you pay attention to the payoff of A and B, you probably would say that you probably agree with me that you would choose B over A on any day, because B has a 5% chance paying 105, where for that same slot, A only pays you 100, right? But I just say if you're using what we know as Sharpe ratio that you learned from your undergraduate study again, let's calculate the average. The average for A is $10. The sigma of A is 30. Assuming RF here is 0, the Sharpe ratio over here will be 0.33 for A. For B, the average is 10.25 because of that is 105, slightly higher. But that 105 also introduced a slight penalty into a standard deviation, where the sigma B here is 30.76. So which means if you calculate the Sharpe ratio, mu B would be 0.333223. Right? The reason why I'm going to 60 decimal places is because over here I use smaller numbers, right? So over here, if you think about, if you base your decision based on Sharpe ratio, you would say, well, I probably choose A, right? Because that has a higher Sharpe ratio. But is that right? If you're looking at A and B together, you would say, okay, of course I would choose B if I know the payoff. So what happens over here? What happens over here is that there's slight upside penalty brought into the calculating volatility for B from that 105. So over here you can see that the higher volatility in B is actually a better outcome, because that just means that you have a more upside. But the way how we calculate volatility is that we pretty much make a penalize the deviation from mean on either side. Right? So which means that in this case, you probably want to think, is there any other alternatives for me to do this comparison? Yes, there will be plenty, because there was different ways to define volatility, right? You can think about semi-volatility. So I have a second example, but I think given the time, you can take a screenshot over here and just do that in your own time. I think that's comparing Oracle and Microsoft. So which means that SVX or VIX hasn't really fixed everything. What's missing in VIX? So volatility takes account of deviations from the mean on both sides. It may be more interesting to see what a proportion of an upside potential versus a downside threat in the changing VIX. And VIX, of course, doesn't tell you how asymmetric the market return will be. And it's well documented that the market returns are not symmetric. For example, if you read two following book and a paper. So we can introduce a partial moment framework over here. So an nth order lower partial moment and an upper partial moment for some continuous distribution f is defined as this, right? Replacing, so if when you're calculating, for example, a second moment, that would be going from minus infinity to positive infinity of h minus r power to 2 of dfr. And but over here, if you replace that, if you replace the upper infinity or down the lower infinity with a certain number h over here, the h here was first introduced in Roy as a safety first disaster level return, and that comes to the partial moment calculation. So in Markovi's 1959 paper, introduces something called semi-variance, which is the lower partial moment degree 2 with h equal to ER. So that saying here is that my threshold is my expected return, or my average return here. And I want to calculate a semi-variance that only looking at what falls below my mean, which means if all the returns above my average, I think that's a positive return, I'm happy for it, but I just want to focus on the return that is below my average return. So you can see that that's what that partial here is suggesting, right? I'm only looking at 1/2 of the distribution, right? So what we can do in Bags and Box framework, so in the partial moment framework here, is that because we calculate state prices, we can just redefine the payoff over here. We can redefine the ranges over here. We can decompose SPX into a forward-looking lower partial moment as a proxy for market downturn, and then we denote as a bear index backs because bear downside. We can also look at the rest of that, which was not downside means upside, and upper partial moment counterpart as the bull index box. Bear, we can using the same methodology but decomposing to either backs or box. And the back and box share the same state prices at each state with a modified payoff. So same state price, but my payoff here is only looking at, for example, only looking at the returns that is less than what my future state what my expected level is going to be. Which means that when I'm looking at the future ranges of state, I'm only looking at the range that will likely to fall below my current level or my forward level or above my forward level, which in other words, I'm only looking at one side of the distribution, right? And with that in mind, we then go on to skewness, right? Because that you can talk about a backs and box, but let's just focus on something a bit more fun on the skewness part. So over here, so we knew about volatility. Why do we care about skewness? And we know the S&P 500 return distribution carries tail risk, and VIX being a proxy for the standard deviation of SPX return, it doesn't capture the perceived risk. So CBOE introduced skew index back in 2011 as a complementary index that measures perceived tail risk. And the beauty of using that index of the methodology is that it actually has the same data input for VIX and skew, right? So some of you may have heard about VIX, but I bet you probably haven't heard about skew index. So in fact, as on 2nd of May 2020, when I was preparing for this workshop slide, I just searched CBOE skew again to think about has there been any discussion on skew? Well, this is what Google will show you, that there was really not that much recent development or recent news about skew index. There was something from 3 weeks ago, last year, December 2019, and there's a one news from 23 hours ago, but it talked about VIX and then as well as skew as a measure of demand of put, and that's actually something else. But that's not just a coincidence. I did the same thing for 2019. If you search CBOE skew, there really isn't that much that much recent topic on it. And even back 2018, I think that's 2018. Sorry, that's 2017 actually. There was around in the month of May. There was really isn't anything going on in May. People doesn't really talk about skewness index, right? It just doesn't actually attract the same amount of attention as VIX. And you would say, why is that the case? Because if skew is trying to be perceived as a black swan index, right, tail risk, then wouldn't that actually receive a lot more attention than VIX in a period like this? Partly if you're looking at the trajectory, so like how I presented to you the trajectory of VIX. So this is a trajectory as of 2nd of May 2020 over the past 10 years. You can see, well, this is probably not well behaved. Not well behaved in the sense that I don't actually know whether there's any pattern for me to talk about. You can stare at it for a second. Can you find any pattern? Is there any well-known behavior that you can point out? I couldn't, right? And let's just keep going. Let's just keep going to think about, why that's the case. Well, so if no news, let's have some history. We talked about 2011, CBOE introduced a skewness index, SKEW, that attempts to forecast the market tail risk. So it forecasts the negative risk-neutral skewness of S&P 500 market returns over the next 30 days. Why negative risk-neutral skewness? Well, it's because empirically, the skewness of the market return has always been negative. And people just not comfortable, as a market participant, you're not comfortable to talk about something negative. Because you don't want to say, it actually went up today. It went up from -6 to -4. What does that mean? It becomes less negative. So in order for people to in order to switch the sign and say, okay, we're talking about negative skewness, which means negative becomes a positive number. And the index the methodology is based on Backstreet, Kapady, and Madan 2003 RVS paper that any security payoff can be spent and priced using an explicit positioning across option strikes, and it has then been well cited in the literature, especially in the literature where people trying to recover skewness from option prices to do a whole bunch of corporate finance study and asset pricing study. So here, let's looking at CBOE skew index, how they actually calculate it. And in fact, I'm probably not going to go through a derivation because it's a bit too long. But you can see that it's not that different from CBOE VIX. Well, first of all, skew equals to 100 minus 10 times S. So minus 10 times S, we already talked about it because, skewness is always negative and people are not that comfortable dealing with negative number in the market. So they switch the sign by introducing minus sign in the front. And then they minus 10 times that because the number is actually quite small. So they make it look bigger and then plus 100. So which means normally if you have a skewness would be say minus 1.2. And after that transformation, that becomes 112. Why 112? Well, you could say that's a behavior financing. It's that, people are not comfortable dealing with something, an index that is 1.2 or 2.3. They're probably more comfortable with 112, right? And that's why we have it. So you can think about this as here, which is the actual skewness, is a product of P1, P2, and P3, and each one's coming from a different what you call the mean contract, volatility contract, and skewness contract over here. But that looks fancy, but the calculation wise, it looks very similar to VIX. Sorry, that's one more thing I want to talk about over here. If you're looking at P3 over here, you can think about the P3 here has a power to P3 minus 3 times P1 P2 plus 2 times P1 cube. So in this case, it just gives you a hint that because there's a cube out there, right? So that means that if there's anything wrong with the measurement of P1, that power to 3 would actually blow it off. Just to give you a hint, right? And if you look at it empirically, we already said that previously we have looking at the trajectory of S&P 500 and VIX. So here the black line goes up and down, is the S&P 500, and the blue line VIX goes up and down and up and down, up when the market goes down and down when the market goes up. It's quite well behaved. But and the red line here is the skewness index, right? You would say, well, I mean, if you're working in the marketing team of CBOE, you probably would have a hard time selling that index because there really isn't that many behavior or that many points for you to discuss. Because if you were someone to believe the trading signal coming from skew, which means when it goes up, the market is likely to hit a black swan event, you're pretty much gonna have a heart attack every single day, right? Because it goes up and down, ups and down, ups and down, ups and down. So you would say the index looks quite noisy, and you would say, Dale, why is that the case? So I think I have a YouTube video here, but unfortunately I can't play it. I don't know why it doesn't work on my iPad. So I mean, hopefully you get an idea that why do we need an alternative? Because the current one is just so noisy, right? So noisy, and there's implementation problems, and discussing Zhang and Tian, and discussing one of my working papers. So for the time being, you know that it was similar errors to the CBOE VIX, but obviously here everything is just blown off in skewness. So if you're looking at truncation, digitalization, asymmetric truncation, so they suffered in the same type of errors, but the errors magnitude in skew is a lot higher and a lot more unpredictable. In terms of my video, I was just gonna go through it very quickly because you can always just read this slide in your own time. It's not really related to our state price one. So if you in your own time, you can read it. But for now, let's just skip it just to show you the errors. So just want to quickly comment, unlike volatility where the error is quite well behaved, it's just gonna be underestimating it in the truncation error, but where in the skewness one, it going from underestimating it to overestimating it. So which means the error type is a lot harder to track and a lot harder to predict which direction that's gonna be. And that probably explains why we see the skewness index just so not well behaved. So I'm gonna fast forward this slide. I'm not gonna talk about it. A lot of interesting graphs over here. Alright, so back to using the state prices. So skewness here is hard to measure precisely, and what we can come up with a simple solution is that take a ratio of the bear index to the box index, which is the lower partial moment volatility over the upper partial moment volatility, to form a market symmetric index 6. So why do we need 6? I mean, I really run out of ways to naming these indices. So because if market return distribution is symmetric, if they are symmetric, then the upside or the downside over upside should be 1, right? But empirically, we don't. So we can use the ratio of bags over box to form this market symmetric index 6. So similar to skew, 6 here approximate how negative skew the SPX return is going to be over the next 30 days, because we have bags over box, which means if you have more in the downside, that means the market becomes a lot more negatively skewed, then this number is going to go up. So it's kind of like how CBOE defined a negative skewness. So we just take bags over box to get to approximate how negatively skewed it is. And we also construct a third moment index as an extension to how we're doing the state price volatility index. So here, using the same state prices but different state payoffs. So the state payoff here is just it's just like how you calculate skewness, right? The central moment, third central moment. So ticks estimate how negative skew it is. The correlation of the 6, the symmetric index, and the third moment index is actually almost 100%, with a change to be almost 95.51%. So that means they're almost the same thing, which is kind of unbelievable, because one of them is just the second low partial moment, second lower partial moment over the second upper partial moment. The other one is the third moment index. We also just, as for comparison, we construct a non-parametric measure of risk-neutral skewness, which is the implied volatility of an L money put option with minus 0.25 delta, minus of implied volatility of an L money call option with 0.25 delta. This is one of the popular approaches that people use empirically as a non-parametric way to measure skewness. So let's just have a look about, let's have a recap about this so far. We define our state price approach. Here's our state price for the phi and state payoff for SVX, BAX, BOX, and 6. And then we're already seeing that how SVX approximates VIX really closely, but better at predicting future volatility. And that's looking at 6 over here. So in this case, black line is the S&P 500, red line is the skewness index, CBOE skewness index, and 6 and ticks, which is our symmetric index, and third moment index is denoted as the blue line and the green line. So what we have over here, so between 1996 and 2013, you can see that when VIX goes down, say, after the dot-com bubble, skewness went up. I mean, the negative skewness went up, which makes sense because that means people fear about it's going to be back then they didn't call black swan, but fear about it's going to be something a lot worse could happen. And when in the in the bull period between 2002 and 2007, when the S&P 500 goes up, you can see that the skewness index, the 6 here, symmetric index, goes down, right? And when prior to GFC, you can then see that the 6 slightly climbs up again, and then has stayed at a relatively high level between 2009 and 2013. So you could say that's a lot better behaved than the CBOE skewness index, which goes up and down, and up and down, and up and down. All right. Let's just have a look at what is the contemporaneous relationship between a risk-neutral volatility and skewness, which means that when VIX goes up, what do you expect to happen for the negative skewness? Remember how every single component over here is matching the negative skewness? So when VIX goes up, as you expect that you will predict a 7.86% movement in 6 and ticks. So which just means that when VIX goes up, people fear about something badly gonna happen. So that's not a surprise to see that relates to a positive relationship, to a positive prediction to a negative skewness, right? So 6 and ticks make sense, as well as skewed non-parametric. But for the CBOE skewness, it suggests that when VIX goes up, there's less chance for you to see a black swan event. Does that make sense to you? You probably not, right? And then we see that VIX responds differently to a decreasing S&P 500 return. But how about for 6 and all the others? So when market goes up, right? When market goes up, you can see that it will lead to a reduction in the symmetric index and the third moment index, as well as the non-parametric skewness. But it actually increases the skewness, the CBOE skewness, which kind of doesn't make sense because when the market goes up, people expect something better to happen, and why would you expect to see an increase in negative skewness? And same thing goes, and in fact, this kind of response is asymmetric for six ticks and skewness non-parametric, though not significant. So for 6 over here, when market goes down, it just means that 6 would actually goes up a lot more. So which makes sense because when market goes down, people worry a lot more in terms of the negative skewness event, which means that comparing to when market goes up, that when the downside movement in the market leads to a higher changes in 6, which kind of behaves like VIX, but we don't observe that for the CBOE skewness or the non-parametric skewness. And we can also think about return predictability. Does a SIX or skew have any return predictability? So over here, when SIX goes up, which means that when there's a high chance for negative skewness, then the future return is going to decrease, which is not a surprise for SIX. But for the CBOE skew, it has the right sign, but it doesn't have any significance. And can SIX or skew forecast the physical skewness? So in this case, we define physical skewness as as it is, which means that when SIX skew ticks and all that is measuring the negative skewness, we expect the sign to be negative. So over here, it's quite surprising that SIX actually predicts the future skewness, but not skew. But then the non-parametric skew over here has a wrong sign. But so we're not sure why that happened. Unfortunately, as a researcher, you just have to report it. So what have we learned over here, right? We learned some application of the state price model using volatility and skewness, but alongside with a discussion of what we see in CBOE, VIX, and skewness. So especially in the discussion of skewness, we see that using an extended methodology based on the CBOE VIX, they come up with a skewness index, right? Using the same data input because it's the same option prices. But we can see that when you calculate the skewness using the CBOE methodology, it becomes a lot more noisy, right? But bear in mind, S&P 500 options out there are the most liquid options type. So what can we actually, is there any insight here? Well, first of all, it could be a manipulation story that we already see. That so although skew is not traded, by having the same data input as VIX, there actually could be more signals coming from the movement in skew prior to the last trading day. So that could be an extension people want to make to talk about the VIX manipulation. And yeah, let's just not worry about it. But is there any other implications? So, but what if it means that empirically, theoretically the model is perfect, but empirically the output was wrong. All right, as one translates the theoretical model from BKM for empirical use with real world data, you have approximation errors. So, but what if this approximation error is a lot more pronounced as the amount of strike price available decreases, right? So, which means that let's just say we already see that as CBOE skew goes up and down, and doesn't really explain market movement, doesn't really explain the movement in volatility index at all. So which means that even for the most liquid options out there, you have this such inferior behavior. What could you say regarding these empirical papers that are using the same methodology for equity options, right? Would you be able to trust the result? Well, I guess that's a big question, right? There's a big question mark over there. So I guess this talk over here, even though we are focusing on the application of state prices, but we hope that this one can be a pioneer subsequent research on this matter to think about maybe as a re-examination of these papers that are using the same methodology as the CBOE skewness index to think about whether you would actually have a new prediction on how skewness predict returns and vice versa. All right. Here I have some more examples. You can read that in your own time. But thank you for your time and questions. If you want to access these slides again, go to my Prezi website. All right. You have a good day.